Hey everyone, and welcome to today's Explainer. We're initiating coverage on a company whose brand is quite literally a global household staple, Energizer Holdings, ticker ENR. Now, behind that iconic Energizer bunny is a pretty complex, classic turnaround story. Management is currently grappling with shifting consumer demand, macroeconomic headwinds, and a highly leveraged balance sheet. So our goal today is simple. We're going to cut through all the noise, evaluate their financials, and determine if this is a hidden value play or a classic value trap. Okay, let's quickly hit the agenda for today's analysis. We're going to start with the Energizer snapshot, then look at their mixed bag earnings, dive into margin recovery versus costs, unpack the debt dilemma, and finally, check out Wall Street's verdict. Right, let's jump straight into Section 1, the Energizer snapshot. When you hear the name Energizer, you're probably just picturing batteries, right? But looking at their 2025 global portfolio, it tells a totally different story. Beyond the core Energizer, Everready, and Rayovac battery lines, they own a massive suite of auto care and fragrance staples. We're talking about legacy names like Armor All, STP, New Finish, and California Scents. They have essentially built a diversified consumer staples engine that spans across performance, premium, and value segments all over the globe. But here's where the story gets really interesting. Even with that massive, globally recognized portfolio, they currently sit at a rather mid-sized market capitalization of just $1.53 billion. Furthermore, they're trading at a price-to-earnings ratio of just 7.7x. For a consumer staples company with this level of brand awareness, that is an incredibly low multiple. It immediately begs the question, are we looking at a fundamentally undervalued business or a value trap bogged down by underlying structural issues? If you track a hypothetical $100 investment over the last 5 years, the reality gets a bit rough. Energizer has noticeably and consistently underperformed both the S&P Small Cap 600 Index and the S&P 500 Household Products Index. It's a clear picture of a company that has struggled to create shareholder value in recent years, which perfectly sets the stage for the strategic turnaround they're attempting right now. Moving on to Section 2, earnings, which are definitely a mixed bag right now. So, looking at their Q1 calendar year 2026 results, there's this really fascinating duality. On one hand, we have a disappointing 3% drop in year-over-year revenue, landing at $643.3 million, and entirely missing Wall Street estimates. In fact, if you look at their organic revenue, which strips out things like currency fluctuations, it actually fell by 5.5%. But completely flipping the script on that top-line miss is a massive beat on the bottom line. Their adjusted earnings per share came in at 94 cents, totally crushing the 47-cent consensus estimate. Essentially, they are selling slightly less product, but they are squeezing significantly more profit out of what they actually do sell. And you can see exactly where management's head is at in this quote from CEO Mark Levine. He is marking a very deliberate internal pivot. Management knows top-line demand has been soft. Trailing 12-month sales are essentially flat compared to 3 years ago. Therefore, the immediate game plan isn't just about blindly chasing sales volume. It's all about intense operational discipline. It's about rebuilding margins that got battered by tariffs and getting back to a healthy cash flow baseline. Which leads us right into Section 3, margin recovery versus costs. The data shows that management is absolutely executing on this front. In their second quarter, Energizer achieved an adjusted gross margin of 44.4%. That is a massive 360 basis point jump compared to the previous year. It's solid proof that their operational discipline and cost control measures are indeed bearing fruit, really helping to cushion the blow from those slumping sales volumes. But, we have to look under the hood here. While the margin recovery is very real, it wasn't purely driven by everyday operational efficiency. It got a huge assist from a $47.6 million one-time tariff refund. On top of that, U.S. production tax credits are expected to pad gross margins by about $60 million this year. Plus, they rolled out some targeted pricing actions. So the takeaway? The margin padding is incredibly welcome, absolutely, but because it relies partly on one-off refunds and tax credits, returning to sustained organic sales growth is undeniably their next major hurdle. All right, let's tackle the elephant in the room in Section 4, the debt dilemma. Pulling S&P Global's forecast data, the sheer size of the problem becomes pretty stark. Energizer is lugging around a mountain of debt from past acquisitions. You can see reported debt spiked to nearly $3.4 billion in 2025, and while it's estimated to tick down slightly to $3.24 billion in 2026, their leverage ratio, debt to EBITDA, is stuck hovering at a painfully high 6.3x. In a macroeconomic environment where interest rates are a constant headache, carrying over $3 billion in debt and bleeding out $170 million a year just on cash interest, well, that's a massive, massive anchor on the company's valuation. It's so much of an anchor that S&P Global recently revised Energizer's credit outlook from stable to negative, and they laid out exactly what would trigger a formal downgrade if consumer spending drops, causing buyers to trade down to cheaper private label batteries, if they can't offset costs, or if they lose market share. But get this, listen to that last point, aggressive share repurchases. In 2025, instead of throwing every spare dollar at paying down that debt, Energizer bought back $90 million in shares because they felt the stock was undervalued. Credit agencies are practically begging them to prioritize debt reduction over shareholder returns right now.
So, with all that in mind, let's wrap things up with Section 5, Wall Street's verdict.
Current market sentiment captures the hesitation around this stock perfectly. Looking at a consensus of Wall Street analysts, the outlook is overwhelmingly neutral. Out of 6 major ratings, we have exactly 0 analysts telling you to sell the stock, likely because that 7.7x valuation has already priced in a ton of bad news. But on the flip side, only 1 analyst is actually issuing a buy rating. The vast majority, 5 analysts, are telling investors to just hold. They are sitting firmly on the fence, waiting to see if management can truly execute this balancing act. And when we check the actual price targets relative to their current price of $22.35, the picture gets even more cautious. Sure, the high target sits in an optimistic $28, but the median target is just $19. That median target actually implies a 15% downside from where the stock is currently trading. This really highlights the deep-seated concern that while earnings are beating expectations now due to cost-cutting and tax credits, the lack of organic top-line growth could eventually catch up with them. Which brings us to the ultimate question for this entire explainer. I'll leave you with this final thought to consider. Will Energizer's new obsession with margin discipline and cash flow be enough to outrun its massive debt load and slumping organic revenue? Can this legacy giant execute the perfect operational turnaround, or are macroeconomic headwinds and consumers trading down going to drain their battery completely? The numbers show a company fighting incredibly hard to optimize its bottom line, but the top line remains the ultimate proving ground. Thanks so much for joining me for this analysis, and definitely keep a close eye on their next few quarters.